The next speaker, his name is Tekin Salimi from Polychain Capital. Now, he recently wrote for CoinDesk about tokens eating the firm, and also for a whole different skill set around building communities in the way that we work. More interestingly, he was asking the question about, is it time for return of the DAO as a way of working? And something you probably don't know about him is that he likes to play chess, which means he's probably a couple of moves ahead of us. Hopefully you can put us a couple of moves ahead too. Tekin, over to you.
Perfect. Thank you so much for that intro. I'm a very lousy chess player. Okay, so I'm going to speak today about operations in the blockchain space. And I'm going to get a little bit in the weeds and in the details, but my hope is that some of the experiences and insights we've had at Polychain, working with a number of the top technologists and top technical teams in the space, will be helpful for the broader community, as well as some of the projects in the room or founders in the room that are still relatively early in this process and maybe haven't thought through some of these things yet. So for those who don't know us, Polychain Capital is a digital asset investment firm. We generally invest in the cryptographic tokens or the cryptocurrencies of low-level protocols in the decentralized stack. And we also make a number of equity investments in the companies building these protocols, as well as companies building other kind of valuable infrastructure or core services around the peripheries of this movement that we call Web3. A few disclosures. Our lawyers required this. This isn't legal advice, consulting advice, investment advice, an opinion on any specific cryptographic token. It's not an offer to purchase an interest or invest in any Polychain vehicle, and the views expressed are my own and not necessarily those of my employer. Okay, now that that's over with, what is the PC 2030 program? So PC 2030 is the operational support function through which Polychain kind of supports the projects that we invest in post-signature. So we're not passive investors. We normally get involved in a project very early when it's a little more than a technical specification document or a white paper, and we help the authors and the founders of that project think through everything from kind of the technical challenges up front, legal structuring and legal setup, recruiting, their development roadmap and pipeline, and eventually to network launch and onwards. So the nomenclature of PC 2030, like the terminology, comes from this gentleman. Does anyone know who that is? I'd be very surprised if there was a yes. So this is a futurist named FM 2030, and that was his legal name, FM 2030. He was perhaps best known for his belief and dream that he would live to the year 2030, at which point he reasoned that he'd likely live forever if he made it to 2030. And we derive a little bit of an analogy at Polychain that we're really motivated by the goal of helping our projects live to 2030 and onwards. So how do we do that? These are the 7 core areas or core competencies of PC 2030. These are kind of recurring pain points that we've seen multiple blockchain projects need support in, and it's where we're best able to add value. So that starts as early as kind of legal incorporation and regulatory setup, recruiting, crypto-economic design of your network, community management, which is something I'm really interested in, security and code audits, liquidity support for founders and teams that are looking to do large transactions in crypto, and executive coaching. Oh, so I don't have time, unfortunately, to speak about all these topics, but I'm going to focus a little bit on legal, which contains a few buckets in and of itself, crypto-economic design, specifically as it relates to your distribution strategy, as well as your token supply design at a very early stage, and then conclude with some comments on community management. So the first thing projects think through in legal, and I'm sure a number of the projects in attendance have thought through, is how do you structure? That's 2 things. That's which jurisdiction do you incorporate in or set up in, and what type of legal entity do you use? So on the jurisdictional question, by now we're all kind of familiar with the most popular and most commonly used crypto jurisdictions. Obviously, Switzerland is a big one and contender for the biggest. Gibraltar, Singapore, Liechtenstein, Caymans, the list goes on. There's kind of 4 considerations that go into that: securities law, taxation, the availability of banking relationships, and substance requirements. So a couple of comments here. On securities law, you don't actually necessarily lighten your kind of compliance overhead by incorporating in a country with more lax securities law, because generally you have to consider or comply with the securities law of every jurisdiction that you offer your token. So there's not much by way of like a regulatory arbitrage in picking a certain jurisdiction. Taxation and banking requirements are perhaps the biggest factors that drive this decision, as are substance requirements. So substance is just kind of legal terminology for the extent you have to go to give effect to your setup. Simple example of this is it's generally not enough today to just kind of throw up a PO box in Zug or some other jurisdiction and say, okay, we're a Swiss entity. We have a PO box there. You have to actually, or most jurisdictions require that a certain number of directors are resident in the jurisdiction. The team spends a certain number of days there. You have an office space. The board meetings are held there, et cetera. And selecting a legal entity largely relies on your choice of jurisdiction, but it should also rely on what your long-term goals are for your network. An example of this is, say I am building a protocol or an application, and I'm really motivated to kind of build this technology and launch this decentralized network, and then move on to another technology and build another one, and then another one after that. And my goal is to be this kind of R&D development studio for multiple protocols. If that was the case, perhaps like a single entity model would work. In the case of a US company, maybe a Delaware C Corp or an LLC. Alternatively, if in that same case I wanted to launch the first network, but then I wanted to have an active role in the ongoing governance and kind of stewardship of that network, one model that we've seen quite a bit of is this dual entity model. So you'll still have that development company, and they'll be, they would employ the employees and build out the protocol, but they would do so under a contract for a governance entity. And that might be a Swiss Stiftung or a Cayman's entity. And the governance entity is the one that actually owns the IP and issues the Genesis block and issues the tokens. And there's some cost plus percentage arrangement between the two. So just a little example of how your motivations are what should drive your choice in structuring. So I don't want to go too into securities law. It's a very elaborate topic, and I could have a whole presentation just on this, and I'm sure there are many presentations just on this. I just want to pose one observation, which is about kind of the state of this utility token argument today. And this usually kind of turns to this viewpoint that if there's some functionality at the time that I launch my network, then my token cannot necessarily be a security. And I think this gets criticized a little bit. One criticism of this is often that, like, okay, what does functionality mean? Nothing in tech is ever necessarily functional. It's always being iterated on and improved. So where do we draw that line? And then this debate tends to be a little bit binary and polarized. On the other view is just this statement that all tokens are securities and nuance doesn't matter. So my simple observation here is that blockchains are inherently transparent, right? So you can actually look to a block explorer post-network launch and start to gauge some stats or some data points on how functional a network actually is. And a few things you might want to look at if you're considering this would be what percentage of tokens are bonded or staked in some type of smart contract, assuming it's a staking protocol. How many smart contracts are deployed on the mainnet? If there's an on-chain governance function, what's the voter turnout like how much voting is taking place? And you can start to actually quantify what utility means on a case-by-case basis. This would actually also be consistent with the way network launches tend to be defined in private investment agreements as well. Tax, everyone's favorite topic. So just 2 points here. The first one is specific to US-centric projects, or at least companies that have US shareholders. For the purposes of the tax code, US shareholder is defined fairly broadly. I believe it's something to the effect of US residents or citizens that own at least 10% of the economic or voting control of your company. If you have US shareholders, there was a change in legislation effective at the beginning of this year, and a new regime called GILTI, which is pretty unfortunately named, that may realize the proceeds of a token offering in the personal taxes of those US shareholders. So if you're in that position, this is something you need to think through early, and I would engage tax advisors on that. I'm sure there's probably many in the room. The other point applies to companies, regardless of whether they're US-centric or not. If you're tokenizing, you probably intend to issue tokens to your founders and your employees as compensation, which virtually every project does. If you do so, that's actually a taxable benefit. So it could be taxed as income at the value of that taxable benefit. The big question is, how much are the tokens worth when you issue them? This is something we often advise our projects to work with tax advisors to very early and an evaluation firm to kind of come to an answer on. And you strategically want to issue them as early as possible when they have as close to a zero or de minimis value that they can have. Also, you generally want to impose vesting periods on your employees and on your founders to align interests for the long term of the project. So you should do so using perhaps a smart contract and issue those tokens early directly into the smart contract. Quick point on banking. Whether or not you kind of perceive yourself to be a money transmission business or have to comply with money transmission laws, it's fairly essential today to run KYC and AML checking before any token offering. And the reason for that is if you don't, you might find it tremendously difficult to find any banking partners. Or if you already have bank accounts, they might get frozen or shut down. This is something that's happened quite a bit in the space. So take KYC, AML checking seriously, and we suggest that you use an established provider as opposed to trying to reinvent the wheel. This is a risk that you want to externalize anyways. We've received a lot of positive feedback on PCOPS, which is the parity solution, or Comply API by CoinList, so happy to make an intro to either of those. The second point is something I just thought was really cool and I wanted to share, and it speaks to something that I'm passionate about in the space, which is if we're looking for solutions to operational or compliance challenges, we should always gear towards one that still preserves the things that we care about in blockchain. I have to give kudos to Matthew DiFerente. He has some code available. It's not a full implementation, but it's available in this link in his GitHub, and I'll make the slides available. But he created a privacy-preserving KYC scheme so that you can use ring signature cryptography such that you run your KYC process and you have a list of whitelisted accounts that can participate. Then you can apply ring signatures, and you won't actually know which account is buying what or how much they're subscribing for. So it kind of preserves that privacy, but they're still able to prove that they were whitelisted. So if anyone's interested in contributing or building this out, please reach out to me. OK, so post thinking about some of these legal issues, you're going to want to think through your token distribution. Generally speaking, projects have tended to fall in one of these three categories. There's a public crowd sale, which we're all familiar with, a private crowd sale, which is kind of a broader token distribution event that's still open to a broader community, but they all have to be accredited investors or otherwise qualified purchasers. An example of this would be Filecoin's token offering via CoinList. CoinList was the portal for that. And then more recently, we're also seeing this third bucket, which is projects kind of entering into investment agreements with select crypto funds and VCs, but then also allocating some percentage of tokens for an airdrop or some type of distribution to the public. So whichever of these you select, or whichever balance of them you select, will probably be driven by regulatory, the state of regulation at the time, but it should also really be thoughtful based on the goals of your network. And that also applies to the token supply design as much as it does to the distribution. And I'll give you an example on the token supply design. So the Filecoin network, the incentive layer for IPFS and this decentralized storage network, introduces 70% of its future tokens via an inflationary block reward. So 70% is probably on the larger side, but it's actually a very thoughtful decision on the part of that team, because to develop a robust network for decentralized storage, a global network for decentralized storage, you need to motivate a lot of miners and storage providers to come onto this network as early as possible. A very profitable block reward is a great way to do that. And there's other requirements and reasons why you'd want a large number of miners. One, for storage, I'd want high replication of my files, reducing single points of failure and kind of assuring high uptime and things of that nature. And also, a number of use cases for storage need low latency, right? Like, I need to be able to, if I'm based in Toronto, have a storage provider that will store my files, ideally also based in Toronto. So you want geographical disbursement. For another project, another hypothetical, Perhaps the network will benefit more from issuing their tokens to a broader community off the get-go, as opposed to keeping so many reserved for a block reward. And what we often advise there, and what will tie into my next slide about community management, and this is my last slide, is that you try to get those tokens in the hands of as many technical contributors and kind of foster as much of a technical community as possible. So I would pose that maybe the best indicator of success in your community isn't like the number of people in your Telegram or your Slack channel necessarily, as much as it is the number of technical meetups or hackathons taking place around the world with your technology, or other projects building and integrating with your technology. So community quality over community quantity is a good way to think about it. And my last point is open sourcing your code base. This is something that you should think through, and it's case by case in terms of when it makes sense to do that. But some of the feedback we've received at Polychain is a number of projects actually found core contributors and core future employees. They ended up hiring these people just because they open sourced their code base early and kind of put their problems out to the world. And then these very technical minds come to your problem and help solve it. It's kind of like catnip for engineers or something. Yeah, that's all I have to say. Thank you guys very much for the time. And if anyone wants to get in touch, they can reach out to me on Twitter, Reddit, or by email. Thank you.
Thank you very much. Please put your hands together for Tekin.